In the stock market, it's often the smallest things that can change the entire course of someone's financial journey. Over the past 20 years, I've met countless investors, and here's the truth. Mistakes usually don't come from having too little knowledge, but from having too much emotion. Maybe you felt this before. When you see a sea of green on the ticker, your heart races, excitement takes over, and within seconds you hit buy. Then on another day, when the market is burning red, panic sets in and you sell everything, only to regret it later. I want you to picture this. You're standing in a crowded room, everyone's shouting, "Buy now!" The price is going higher. Don't miss out. That moment feels exactly like walking into a casino. Bright lights, loud noises, adrenaline everywhere. And if you haven't prepared yourself mentally, you'll end up the loser in that game. An older investor once shared with me, "It took me 10 years to understand that money doesn't just come from choosing the right stock. It also comes from knowing when to do nothing." Sounds like a paradox, doesn't it? But that's the essence of long-term investing. Sometimes your greatest strength is patience. In this business, I've seen many stories. Young investors, full of energy, pouring everything they have into a few hot stocks just because someone swore they would double. And yes, sometimes those stocks do shoot up, at least for a few weeks. But then they crash, wiping out sweat, effort, and hope. I still remember a heartbreaking case. A family had to sell their house just to pay back margin debt after a junk stock collapsed. Why? Because they believed in sweet promises instead of the real numbers in a financial report. I'm not telling you this to scare you, but to remind you the stock market has always had its classic traps. Whether in the US or Vietnam, manipulators know how to create fake liquidity, inflate the value of tiny companies, and sell you the dream of striking it rich. And when you finally jump in with all your enthusiasm, they quietly slip out, leaving you behind in a room filled with red numbers. That's why the first thing I want to emphasize is this. Always keep positive cash flow. Never let your spending outpace your income. And more importantly, set aside a portion for saving and investing. A smart investor never gambles their entire life. They only risk what they can afford to lose without destroying their future. The second, and perhaps the hardest challenge, is controlling your emotions. I watched an entire generation of young U.S. investors during 2008. They didn't just collapse because the market crashed. They collapsed because they put all their faith and emotion into numbers that were never real. They had no emergency fund, no backup plan, and when the storm hit, they were forced to sell at the bottom. Meanwhile, those who had reserves stayed calm, quietly buying great companies while everyone else was panicking. Do you see the difference? The market is like an ocean. When the waters are calm, anyone can swim. But when the storm comes, only those with a lifeboat survive. And your emergency fund is that lifeboat. I also want you to remember this. The best stocks don't live in the headlines or the hype. They live inside businesses with true value, a clear competitive edge, honest leadership, healthy financials, and most importantly, a price that makes sense when you buy. That's real gold. Junk stocks, on the other hand, are just pretty bubbles, shiny for a moment, but gone the instant the wind changes. And finally, I want to leave you with a question. What kind of investor do you want to become? The one who chases every short-lived wave and drowns in regret? Or the one who moves slowly, steadily, and lets their wealth grow year after year? In the end, investing isn't a game of luck. It's a journey of patience, discipline, and wisdom. And if you begin this journey with the right mindset, you'll see the market not as a place full of traps, but as a great teacher, a teacher that helps you grow, not only in your finances, but in your life. When people talk about the stock market, they usually think of it as a place to get rich quickly. But here's the truth. The very place filled with opportunity is also fertile ground for some of the most classic traps. And if you've ever lost money, chances are you've stepped into one of them at least once. Let me tell you a story. Back in 2007 in Vietnam, there was a group of stocks called the Song Da family. These were tiny companies with little real business activity, but thanks to manipulation by insiders, their stock prices skyrocketed. Rumors spread like wildfire. If you don't buy now, you'll miss the chance of a lifetime. Online forums were flooded with fake accounts, hyping them up, painting a picture of endless growth. The result? Many stocks rose 5 to 10 times in just a short period. Thousands of retail investors jumped in like moths to a flame. But when the manipulators quietly pulled out, the stocks collapsed. Families were wiped out. Dreams shattered. And this script doesn't just exist in Vietnam. Here in the US, I've seen even bigger illusions. Think back to the early 2000s, during the dot-com bubble. Dozens of tech companies popped up. Many had no real products, no profits, nothing tangible. But just by adding .com to their name, their stock prices soared. Young investors at the time believed they were standing at the golden moment of history. But only a few years later, the bubble burst, erasing trillions of dollars and turning paper millionaires into broke reality. I had a client back then who poured all his savings into one flashy internet startup. When I asked why, he simply said, "Because I was afraid of missing out." And that's the most common emotion that drives people into traps. FOMO, fear of missing out. Have you ever felt that way? Watching a stock climb day after day, your stomach churns, your palms sweat, and you think, if I don't buy now, tomorrow will be too late. But in reality, it's in that very moment, when emotion takes the wheel, that you're most vulnerable to becoming prey. Another trap I personally witnessed was with a Vietnamese stock called CVN around 2012. This was a weak company with no strong products and shaky finances. But through fake trades back and forth, manipulators created the illusion of high liquidity, making it seem like the market was paying attention. The price shot from 10,000 to 40,000 dong. Gullible investors believed a big wave was coming and piled in. But then came the dump insiders, used the stock as collateral for margin loans, then walked away. The price crashed to just a few thousand. Brokerage firms couldn't liquidate fast enough. Many lost billions of dong. Some even went bankrupt. That story reminds me of a similar one here in the US. GameStop in 2021. A movement on Reddit pushed the stock of a struggling video game retailer from a few dollars to hundreds. Millions of small investors rushed in, creating a media storm. But when the wave passed, most were trapped at the top. Only a handful who exited in time actually profited. Do you see the pattern? No matter where, America or Vietnam, past or present, the script is the same. A compelling story is built, a crowd believes it, money pours in, and in the end, only a small group of insiders walk away winners. From my own experience, I've learned one thing. The market will never hand you an easy ticket to wealth. If an investment sounds too good to be true, it almost always is. So how do you avoid these traps? The answer, I believe, lies in going back to the basics. Don't buy a stock just because someone said it will rise. Don't trust liquidity that can be artificially created. And don't let greed or fear of missing out dictate your decisions. A seasoned investor once told me, "In this game, the winners aren't the fastest. They're the ones who survive the longest." It sounds simple, but survival means saying no to shiny traps. It means learning to wait patiently for real value. And remember this, there will always be new GameStops, new .coms, new inflated bubbles. But if you build a foundation of solid knowledge, a steady mindset, and a long-term strategy, you won't be swept away by the crowd. Instead, you'll stand aside, watching the waves crash, smiling quietly, grateful that you didn't jump in with them. When I look back on all the years I've spent in the market, I realize something fascinating. The stock market doesn't just teach us about money, it teaches us about life. The ups and downs of stock prices often mirror the highs and lows of our own journey as human beings. Sometimes we celebrate, sometimes we despair. But in the end, the most important thing is whether or not we can remain steady. A seasoned investor in New York once told me, "I didn't get rich by hitting big wins. I got rich by avoiding deadly mistakes." That, to me, is the very essence of value investing. You don't need to win every battle. You only need to protect yourself, choose the right battles worth fighting, and let time do the rest. So what lessons can we draw from this? First, value investing is always more sustainable than chasing short-term waves. Stocks of truly good companies, with real products, real markets, transparent leadership, and healthy finances, are like oak trees. They don't grow overnight, but over the years their roots sink deep, and you can sit in their shade for a lifetime. In contrast, junk stocks and manipulated price runs are like weeds. They sprout fast, look green for a moment, but when the dry season comes, they vanish without a trace. Second, discipline and preparation matter more than prediction. The market will always face black swans, unexpected events like financial crises, pandemics, wars, or surprise decisions from the Federal Reserve. You can't control those things, but you can control yourself. An emergency fund of 3 to 6 months income, a diversified portfolio, and a steady mindset, that's the armor that keeps you standing when the storm hits. A friend of mine nearly lost everything during the 2008 crisis. But what saved him wasn't predicting the market. It was preparation. He had reserves. He had a plan. While many panicked and sold, he quietly bought shares of companies like Apple and Microsoft at bargain prices. 10 years later, his wealth had multiplied many times over, and it all started with being prepared. Third, learn to go slow. In today's world, we're addicted to speed. We want fast money, fast results, fast success. But the stock market works the other way. It rewards patience and punishes impatience. I often tell my students, don't look for a way to get rich overnight. Look for a way to get rich over 10 years, because time is your greatest ally. Have you ever wondered why Warren Buffett, one of the greatest investors of all time, often says, the stock market is a device for transferring money from the impatient to the patient? The answer is right here. The market moves up and down every day, but real value takes time to reveal itself. And only those who wait get the reward. There's another perspective I want to share. Treat investing as a journey of learning, not just a hunt for money. When you analyze a company, you learn how the economy works. When you endure a market crash, you learn how to manage your emotions. And when you hold a good stock for years, you learn lessons of trust and perseverance. In the end, those lessons are worth more than profits. I want you to imagine yourself 10 years from now. When you look back at who you were today, do you want to see someone who chased hot trends, losing sleep and anxiety? Or do you want to see someone who went slow, steady, and ultimately gained true financial freedom? The stock market at its core is not a casino. It is a test of character, patience, and discipline in a world full of temptation. And those who pass that test find that the reward is not just wealth, it's also a calmer, freer life. And maybe that's what we're all searching for.